The markets produced a indecisive trading day today, but as you can see, after the recent uptrend and the gap up doji, which was a clear sign that there might be exhaustion, the lower open this week told us they were probably coming back to the T-line. As you can see, over the past 3 days, the T-line has been a relative support level. This also allows for the analysis of what would happen based upon how things open after the doji day. The simple doji rule implies that the price is usually going to move in the direction of how they open after a doji. If they open it lower, that means probably the T-line is now in jeopardy, that we could be moving back, possibly creating this trend channel for the longer term. On the other hand, a bullish open would create the possibility of a J-hook pattern, which would imply that if this was wave 1, wave 3 was going to be the same magnitude, and would also imply that this resistance level right here would probably be breached and that we were still in a strong uptrend. Knowing that allows the candlestick investor to prepare their portfolio to be situated in the appropriate direction. Obviously, a lower open, you want to take a look at some short positions. A positive open tomorrow, meaning if the pre-market futures showed a market opening stronger, then you probably want to start going after longer positions or long positions with the anticipation that if there's a J-hook pattern setting up, there's going to be a few weeks of bullish trading. What makes candlestick analysis much more comfortable to trade is the fact that we can identify good pattern breakouts. This is what we call the bobble breakout. It came up, failed at the 200. Notice how the T-line crunched the trading right back up through this level. Once it broke out, this now becomes a bobble breakout. And now our next assessment is we can pretty much stay long as we stay above the T-line. So you can be in positions that are very easy to assess when to hold and when to get ready to sell based upon a very simple rule. The uptrend remains in progress until we see a candlestick reversal signal and or a reversal signal and a close below the T-line. The fact that crude oil prices have been continuing to move up slowly, the oil stocks like Whiting, WLL, continues to move up. Once again, a very simple trading scenario. Notice our kicker signal down here that started this uptrend. How long do we hold this position? Once again, until we see a sell signal and or a close below the T-line. However, notice what happened on this today. Gap up, big trading day in the overbought area. This is where the Japanese rice traders have produced extremely good analysis based upon candlestick charts of what happens normally in human nature. Where do most people buy? They buy exuberantly at the top. What shows exuberance? A gap up and a big trading day in the overbought condition. That should be the alert to start watching for a reversal signal. And we started buying our IOT today based upon, notice the slow curve. And when it broke out, look where it broke out, through this resistance level and the 50-day moving average, producing a slow curve, high explosive breakout. This is a very common candlestick pattern that allows you to identify when big price moves are about ready to occur. Now we can use our assessment of where you think the next target's going to be now that they've broken through the 50-day moving average. Probably back up here to the 200-day moving average. Candlestick analysis is merely the graphic depiction of investor sentiment, and the patterns they set up will be the prelude for very high profit trades. That'll be it. We'll see you in the chat rooms.